What's up, traders? Jason here from Breakout Traders, bringing you back another video. And in today's video, we're going to be talking about how to make $100 daily day trading stocks. So this topic is pretty important today because there's quite a few people out there that are struggling day traders, whether it be the inconsistency, not following the rules, discipline aspect, or even just not knowing where to start. Well, in this video, we're going to be talking about all of that, so stay tuned. So before we get into the goods, just a reminder and a disclaimer that trading is very risky and all the information provided in this video is for educational purposes. So on the agenda today, we're going to be talking about 8 topics. First one being the preconditions, what's required for trading. Next, we're going to be talking about locating active and trending stocks, very important and determined to build that watch list, followed by identifying the stocks and the news catalysts. Next, we're going to be talking about analyzing chart levels and direction, followed by identifying the one of 3 critical patterns, then setting your risk parameters, waiting for the perfect execution, and then managing the trades. All right, so preconditions. Preconditions are very important because we need to have these fundamentals before we even start trading. All right, so the first thing, you need to have a funded account with a valid broker. Right? And what I mean by funded account is that we're looking for around minimum 3,000 to 5,000. Of course, maybe 10,000 is the sweet spot because that gives you more flexibility in terms of trading. Whereas 3,000 to 5,000 you can pass by with trading small account and then building up. But we won't get into that topic. We can save that for later. Next, you want to have a legitimate charting software such as Dash Trader Pro or Thinkorswim. Charting software is really critical because it helps you identify trades, whether it be the patterns, the charts, the technical analysis, etc. And having such a tool like Dash or Thinkorswim will give you that leverage. There are other tools out there such as the IB platform, Trade Workstation, or Trade Zero. These do work, but of course they're not as preferable because speaking of my experience. Also, it's great to have some experience with executing trades. So this kind of falls back on number 2. When I mean by executing a trade is how does the platform work? How do you execute trades? So, and how do you get in? How do you take partials? How do you get out? Whether it be taking those stop losses or hitting those targets, right? And just being quick on the fingers, whether it's using your mouse or hotkeys. But that's a bit more advanced, but just being familiar with the tool, how it works, understanding the software, understanding the charting aspect is definitely a key component. Also, having general market knowledge, definitely a big bonus. I would always suggest to have some general sense before getting in rather than dumping in and swimming with those sharks. Next, you want to have the necessities, right? The computer, monitor, fast internet, right? I don't recommend trading off the phone. I know a lot of new generations, they have their phones out and are trading off the phones and executing off the phones. That's definitely a no. I find that quite funny because you're trading against the best people, the sharpest minds in the world. And by using a phone, a little 4-inch, 5-inch screen is not going to help you one bit. So all you need is computer, monitor, internet. I personally use 3 monitors. 2 is okay, acceptable. 1 you can still pass, but definitely use a computer. And then the last thing about the preconditions is don't have a morning time constraint. It's best to have availability to trade the market open because the market opens at 9:30 Eastern. So you want to be there for that 1 hour when it's most volatile. If you don't have availability during this window, it might be a bit more difficult because trades are not coming as fast and it may make more time to elapse on those particular trades. So as you can see here, these are the 2 charting softwares that I was referring to. On the left-hand side, we have Dash Trader Pro. You can see that the chart is nice and clean, crisp. We have the candlesticks followed by the moving averages, the nice montage level 2, where you can execute your shares. You can put in the route, whether it's like a limit or market order. Then you have the buy, short, and cancel buttons. Super easy to use. And also on the right-hand side, we have also Thinkorswim. I personally haven't used Thinkorswim, but I've heard great things about it. So number 2, we're going to be talking about locating active and trending stock. So what I mean by active and trending is that you want to look for something that's preferably gapping, that's plus or minus 3% in the pre-market. Usually with these gaps, there is a high relative volume, which is the RVOL, and which also means it's catalyst driven. What I mean by that would be maybe perhaps there's a new CEO, there's a new product, merger acquisition, rumors of some type of news, whether it's FDA approval, etc. Lots of information, lots of news, therefore there's a lot of eyes, and that's what causes the high relativity volume because people are trading it. And then next thing we want to talk about is also the best opportunity for continuation because it provides more follow through and less prone to fake outs. So in order to locate an active and trending stock, there are procedures. So you can use resources to assist with finding active and trending stocks. So for instance, Dash Trader Pro has a high and low scanner involved, which provides you that support, and also a top list that provides those most active gains or loss tickers. There's a free resource called stocktwits.com. I would highly recommend you sign up for that. Not affiliated in whatsoever, but they have a page where you can see the most active and trending stocks, which will give you a good indication. And then next, there's also other particular tools such as FinViz or Trade Ideas. What you'll do is you want to add everything that's plus or minus 3%, add it to your watch list. Doesn't matter what it is, add it, whether it be there's maybe 5 per day or whether it be 50 per day, add them all, and then the next step will be to shortlist them. All right, so DAS has the high-low scanner, as you can see on the left-hand side. These are all the low of the day scans, and on the right-hand side, these are all the high day scans. So we want to look for things that are above or below 3%, and we can see here there's quite a bit that's below 3% that we want to throw on the watch list, and vice versa. In the middle, we have the top list, which helps out with identifying particular stocks, whether it be active, most gained, most lost, etc. And then we have on the right-hand side, the free tool StockTwits, where we want to look for that trending, right? So for instance, we see that there's many stocks trending that's above or below that 3%. We'd want to add all these to your watch list. All right, number 3, we want to identify the stock and news catalysts. So the idea of this is that we want to ensure your ideas only include real companies and not ETFs or dual listed stocks. We also want to talk about tickers that may move independently from the overall market conditions and or macroeconomic news. So some tickers may move independently from the SPYs or the triple Qs. A lot of the times, like as in speaking right now, everything is moving with the SPY or Qs. So you just want to be cautious about this just because levels or pivots on specific stocks may not respect because it's actually following the Qs. So just got to be cautious there in terms of seeing if they're independent or not. And lastly, a news catalyst is more likely to support a healthy trend due to more eyes. So the procedure with identifying the stocks and news catalysts is that there are tools out there which are free, such as Google Finance. So I would suggest going to Google Finance, typing in what's in your watch list and identifying if it's a real stock or not. If it's a real company, keep it on the watch list. If it's not a real company, such as those 3 times velocities, remove it from the watch list. And I want to make sure that because it's a catalyst-driven stock, do not turn this into any type of fundamental trade. And I'm going to repeat that. Do not return this into a type of fundamental trade because we're talking about day trading and we want to make sure that this is only day trading and not going to turn into a swing trade or a core trade. I also wanted to mention, based on the news catalyst, I would also check other sources such as StockTwits, Twitter, FinViz, or even a simple Google search to see what the news catalyst is for the particular day. Just keep that in mind that it has to be that particular day in order for that news catalyst to be relevant. This could either happen in the pre-market or in the after hours prior to the session. All right, so now we're getting into the scanning aspect. So based on your watch list, we want to scan through each particular stock to identify if they're real stocks. So in this example, we have the VIX, we have Pro Shares Ultra Pro, Triple Qs ETF, we have 3 time velocity, 3 time velocity. If these are on your watch list, please remove them because they're not real stocks. We want to look for real companies like Amazon, Facebook, etc. Moving forward, here's an example of dual listed stocks. Although these may be real companies, when you look at the particular chart, very gappy. Each day has a weird gap, right? It's not a clean and a concise chart. As a result, these are dual listed. I would avoid these at all costs. All right, so now we're on topic 4. You want to analyze chart levels and direction. So this is very important because it helps paint an overall picture of the chart direction. It also helps identify levels of support and resistance. This is very key. The support areas, resistance levels, or pivots are areas which may bounce And this kind of falls through to the third point where it helps to determine the reward to risk ratio. So if a trade looks nice, but support and resistance is close by, that might not provide the best risk reward ratio. And we want to look for trades that maybe give you 3-4x per trade. And then we also want to always factor in the overall market when analyzing chart levels and direction. So the procedure, scan through each idea separately. So now that you have the cream of the crop, you filter out your specific watch list, you remove all those dual listed, you remove all those ETFs. Now you only have true specific stocks. Check out timeframes, including larger timeframes, whether it be weekly, daily, 60-minute. See if it fits your trading criteria, right? So what I mean by trading criteria is the stock at all-time highs, all-time lows. Does the stock have rewarding room to the next level? Basically, I talked about that risk reward ratio based on levels of support resistance. Also, is a stock in the novice or professional gap? So what I mean by novice is it the end of a previous move or a professional gap, or it's basically the start, the igniting of a new move. And then lastly, is the chart nice and clean, no erratic or wiki. So nice tight consolidation. So for example, we have figs here. We can see that if this was the day of the gap and this is the morning, we see that there is potential where there's one pivot here, next pivot there, that based on your risk reward, this could be a nice trend down. And as you can see here on the 5-minute chart, blew by it, and you had a nice actually trade right here, which was basically a base breakdown, which you could have gotten once it touched that declining 5 moving average. On the flip side, you might have not a nice chart based on the wicks, the spread. This is Facebook, so it's a bit more in terms of volatile, but if this was the gap, you see the gap is a doji, previous candle is a doji, and then you have the gap here. Where is it gonna go? You have a pivot here, the next pivot high could be here, range bound, right? Followed by this, by BY. I'm not sure what this ticker is, but see that there's a red doji. So a lot of inside days within the past maybe 5-10 trading days, which kind of makes it iffy. Not really worth trading, right? That'd be best if it breaks above that consolidation, then you have room to all-time high, or vice versa. Next, we want to talk about identifying the 1 of 3 patterns. So TA, technical analysis, and patterns help provide a competitive and predictive advantage. Having a strong knowledge of TA is definitely helpful in terms of supporting your trades. Also, it helps keep things systematic and prevents impulse trades because you're trading off of patterns rather than impulse or randomness. Once you gain experience, patterns become easily recognizable, so you can scan the charts super quick or in your watch list. So for me, if I have 50 charts, I'll just run by them really quickly, scan a few different time frames. If it looks good, keep it. If it doesn't, delete it. All right, so now let's talk about the 3 patterns, right? There's the long setup / short setup, which is, this is the long version, short version. There's also a breakout long or breakout short. And there's also climactic longs and climactic shorts, right? People talk about head and shoulders, cup and handles out the window. So the procedure for this is that you want to add all these items to thumbnails. You want to wait for the pattern to set up. So based on experience, traders can spot them easily. You'll get the hang of it once you get more screen time, which is always a bonus. And then next, if a pattern appears, place it on your favorite thumb and hard scope for an entry. All right, so here's a screenshot of my thumbnail list. So on my top screen, I have 12 watches, which I'm watching based on my watch list. And then at the bottom, I have the cues at different time frames, followed by the SPY at different time frames. Next, I have my main monitor where I keep my favorites. So as you can see here, I have 1 for my favorites with a level 2 montage. So 2 charts. This one's a 2-minute chart. This is a 1-minute chart, followed by main favorite, which is followed by 3 charts. Level 2, of course, 5-minute chart, 15-minute chart, daily chart. And then at the bottom left is I have options. So we'll just keep that because we're not talking about options today. But if I wanted to switch it up, I do have 1 chart and another L2 if required. So what I would do in this case is if I see something beautiful or setting up on my thumbs, I would come down here, throw the ticker in, and then watch that and snipe it as possible. All right, so let's just get into the patterns, right? So we have the long setup here, short setup here. And basically this is a very simple pattern where basically we're just looking for pullbacks, right? So in this example, bar up, 3 bars back, which is basically a pullback to the moving average, and then it pops up. Same thing here, 3 bars back, and it pops up coming to that particular moving average, whether it's an 8 moving average, a 20 moving average. And then basically we have identified where the stop and entry would be. So of course the entry would always be the break of a new bar. Never get in prematurely. It's always the break of a new bar. And then the stop would be that low of the bar, whether it's 1 cent or 3 cents. And then on the right hand side, we have the same thing, short setup, except for the moving average actually should have been on here, not at the bottom, because basically we're looking for it to come to that moving average in order to get in. So if the ticker was looking like this, where the moving average was on the bottom, but the entry is up here, that is not a true sell setup. All right, so the next pattern we're even talking about is the base break long and base break short. Probably the most easily recognizable pattern because it's basically a consolidation here. You can see nice tight bars. But the one things we want to talk about here is that consolidation happens. A lot of people tend to maybe get in a bit early right here on the break, right? Or maybe right here in the break. The idea is to wait for that moving average to catch up and then put an entry right when it breaks that particular base. I won't get into too much detail, but basically it's even more powerful when this happens at round numbers such as $80 or $70, $150, etc., rather than at an arbitrary number like 145.20. On the flip side, same thing. Basically, you wait till it comes to the moving average and then you get in and strike with precision, putting your stops depending on how risk tolerant you are. And then the last pattern would be a climactic long or a climactic short, when you see it basically come down really fast with the volume increasingly rising. But this has to come down like a waterfall, right? It can't be coming down at a 45-degree angle. It has to start falling and then basically it falls off the cliff, and vice versa. You have a volume where it just basically picks up speed. And the reason why it picks up speed is because once it comes back down, you have an influx of sellers, and also you have now an influx of buyers who are trying to do that push and pull battle. And then once it happens, you can see here a reversal happens, and then you can get in. Basically, once that bar forms, entering on the break, stop below that with a target around that moving average, whether it's that 8 moving average, 20 moving average, etc. Some other key aspects to look out for is that you need these last bars to be wide range bars. These can't be small bars with the significant volume coming. Same thing happened on the flip side, basically, where significant volume comes up, you have it basically pop up with wide range bars, followed by a COG or change in the guard with a narrow range bar. All right, so now we talked about how to find stocks, how to add them to your watch list, how to filter and narrow them down, how to display them on your thumbnails in your favorite watch list or your favorite charts, and then followed by 3 key patterns. Next, we're going to be talking about how to set risk parameters. So first off, you want to predetermine the dollar risk before entering any trade. We also want to verify if the reward to risk is favorable, and we want to see if each trade and we also want to make sure that each trade is treated equally, as never one trade should be worth more than the other. But let's get back to this, verify and confirm that the reward to risk is favorable. So I'm going to use this as an example. So we see here, if we entered here, stop here, this is basically the one risk. We want to make sure that, and if this is the second target, that looks like it's a favorable risk, at least 1-to-1 or 1.5-to-1. But what if the chart or the bar was right here? Sorry, right here. So I use that as the top of the bar. Same entry, same stop. Would this target be valid? The risk would not be, because that's only giving me a 0.5-to-1 reward to risk. So something like that would not fly and would not be recommended. Okay. So the procedure, based on your entry, have a predetermined stop loss based on the previous bar low or high. Whole number or pivot area, if all 3 align, even better. Based on your stop loss, have a target area based on your level of risk, and also aim for a minimum of 2-to-1 reward to risk ratio. This example of what we're talking about, which is the entry, the stop loss, and the targets. So if your entry is at $44 and your stop is at $43.50, we know that we're risking basically 50 cents per trade for 1 hour. So we always want to look for a minimum 2 hours. 1-to-1 is acceptable, but we don't look for 2 hours. So we can see that $44.50, a 50-cent move is 1 hour, or $45 is 2 hour, which is a dollar move. So basically, we always want to verify and make sure that this risk is always achievable based on those particular charts. So execution. So waiting for the correct execution. So this is important because it helps provide a valid entry based off of the 1 of 3 patterns discussed. It's also important because it helps set risk parameters to determine if the trade is worth it, and also magnifiers to increase the chance of a better trade. So in order to execute perfectly, we want to make sure you wait for the opportunity to execute the trade. Do not get in prematurely. Do not get in anticipation. We want confirmation, right? So what I mean by confirmation is we want to wait until the previous candle closes to enter the trade. Do not enter prematurely. And also, in order for execution to be even better, there's things called magnifiers. So based on the pattern, we also have magnifiers such as if it's near or rising, if it's at or near that rising or declining moving average, if the bar is a change of guard, if the bar is a narrow range bar, it has a bottoming tail, or around a whole number. So for example, I'll bring this up. We can see here that we see that there is volume. This was a COG or changing of the guard, narrow range bar. So that gives additional bonuses or amplifiers, right? We can see here, as the example, what happened. There's not really true amplifiers here, except for that it's coming to that moving average. That is about a bit, but this is a nice consolidated base. And maybe we can say that this was also maybe a climactic, not really, maybe on the 1 minute chart, but we'll have to verify that. But these were nice bottoming tails indicating a potential reversal. All right, so I'm going to show you an example of a great trade, a trending moving nicely and respecting that 5 declining 8 moving average, with each new candle low providing a entry. All right, so I'm going to provide you an example here of the SPY on a 5-minute chart that was trending very nicely and respecting that 5 declining 8 moving average. So 8 moving average is the light gray, 20 moving average is the black line. And as you can see here, every time it came to respect that 8 moving average, it gave a nice opportunity with a stop above the candle. Same here, once it came, put the stop above. Same thing here, stop above. Same thing here, stop above. Beauty. You probably would have held this all day until close. This was not a valid trade because this was kind of farther away from the moving average, so I don't think that it's valid. And then last thing we're talking about, how is it manage a trade? So when we're in a trade, how do we manage it, right? When do people usually tend to exit? A lot of people exit based on fear or greed, where they get out too soon or too late. There's not no systematic approach how they exit, so they're just getting out at arbitrary numbers or getting out based on their P&L, which is definitely not a good method. So the procedure for this is that there are various methods of trade management, whether that's bar by bar, pivot management, moving average management, climatic management, or hybrid approach, which is taking one or multiple of these at once. So we're going to talk about trades, and these are real examples of my trades. So as you can see here, this is what we would call a climactic long. And you can see here that volume was picking up. And then we had this significant volume on this bar, right? And then we can see that the downtrend, I guess I'm assuming that these would be kind of the igniting, and then these were getting into super wide range bars. And then we see that there's one bottoming tail, 2 bottoming tails, narrow range bar, which gave you a good sign. Maybe this is an entry. You could either A, put your stop here or put your stop below. Of course, I went to stop here. If I went in here, my stop would be here. Even luckily to get a 1-to-1 trade. But since I took my stop a bit lower, I was able to get minimum 2-to-1 on this particular trade. And the method I used to exit or manage that trade was a pivot management system. So we're going to come back, pivot management system. Next, we're going to do the same thing. Real example. This was not a truly climatic sell setup, but it was more based on a reversal, which is I didn't really identify in what we talked about, but basically based on the level, we see that this was the entry, put the stop above the high of the day, and I exited at what? The whole number and the moving average, 20 moving average, which was the hybrid approach as well. Another real example. This was a nice trade I took here. As you can see, nice downtrend, right? This could be the start with the igniting bar coming down, tails again, comes back up. Enter prematurely, but I'm entering because of that previous day close and that level, that 292 was the daily level. So I had to stop just above the candle with a exit down at 290 full number. So this was about a 5-hour trade, very beautiful, executed based on that sell setup off that declining moving average. All right, so this comes to the end. We're just gonna go through a quick review what we talked about. So the preconditions, making sure you have the right tools, necessity in order to trade, whether it be account balance of 3,000 to 5,000, preferably 10,000. We also talked about locating active trending stocks. How do you find these particular stocks? Free tools such as StockTwits, FinViz, or if you're using a platform like DAS, we have that capability. Also, how to identify stocks, news catalysts, right? Go to Google search, verify if it's a real stock or if it's not, and then also do some further investigation on that particular stock. Next, we talked about also analyzing chart levels and direction, right? Whether it be the daily chart, whether if it's a clean chart, whether if it's, next we talked about analyze levels and direction. So we want to look at the specific chart at different time frames, daily, weekly, 60-minute, 15. We also want to identify if it's a clean chart, not erratic, or if it's actually a real stock that's not dual listed, etc. We also talked about the 3 patterns: the buy setup, the short setup, the base break long setup, base break short setup, climactic long, and climactic short. We also talked about risk parameters, having 1-to-1 or 2-to-1 minimum based on your preference. Also waiting for the perfect execution, right? Rather than going in prematurely, waiting for it to actually the candle to confirm and get on the break. And then how to manage this trade, as in how to exit the trade, the various methods: buy by bar, pivot management, moving average management, whole number management, etc. All right, so this basically concludes it. If you have any questions, let me know. This was super high level. We didn't really go into detail because there's a lot to discuss on actually each topic, and I wanted to keep this short, under 15 minutes. But if you have any more questions, feel free to leave a message in the video. Feel free to DM me on Instagram. And I also have a link here, which I'll post in the description to join the Discord room. All right. Thanks for watching. Trade safe. Peace.